Hi, this is Randy Finney with Right Side of the Chart, and this is a post-FOMC update. It is 2:29 right now on Wednesday, March 22nd, 2023. So Powell will be coming on in 1 minute, doing his press conference, and what I'm going to do is, he's going to do what he's going to do. The markets are going to do what they want to do, and I figured it'd be a good time to do one of these videos where we can kind of record it and watch things live as he comes out and talks. And if I've said it once, I've said it a million times. The initial reaction is almost always faded, not the one that sticks. So here's 2 p.m. right here. You can see on these are 1 minute candles. So from 2 p.m. that pop right there, we rallied about 1% on QQQ. You can see my pop-up box to the left on the bottom. There in green shows a 1% rally, followed by a 100 and then some percent fade of that rally. Went up 1%, down 1%. Now, okay, that really doesn't mean anything unless you're an active trader. You just can almost, again, it's probabilities and odds. It doesn't always guarantee you're going to fade the initial reaction, but very often you can do that. Wait for about a 1% drop, buy that, or a 1% rip, sell that. Now, okay, this is what I call the post-FOMC noise. It's going to continue that way, but Powell will get on here and talk, and then so you have, this is phase one right here, the immediate reaction following the Fed announcement, as I expected, and I think everybody else, quarter point that was baked in the cake. This Fed doesn't do surprises, so we didn't do 0 or 50. Came in right where the consensus was. And now you'll see, as Powell talks, market will do this or that. I want to just, I'm going to start out here just to reiterate, I am personally still short and on the markets, swing positions, and I'm going to hold those for now. I'm very, very much like, in fact, and this is a person, sticking with a trade that's going against them. First of all, where we are the other day, where I threw out that fade the FOMC post. Let me grab that. We're really, right about where we were. This is it right here. I've zoomed in. Let me zoom out. We're talking a minuscule amount. This is that high from the other day, that first divergent high, and from that point we're only measured this way. We're less than 2% above there, so that's not much. Now we don't yet have. I thought it was. I still believe it's imminent, and if it's going to trigger, it'll probably trigger when Powell talks. The break of that trend line. It's just a beautiful trend line, and trend lines like that, we say support is support unless broken. But with the divergences, I still put good odds that's going to be broken. There's your previous reaction high right there in the NQs. That's the Nasdaq 160-minute chart. There's our divergence. And so what I was saying a minute ago, the only thing different with this marginal new high and the fact that we didn't get a bigger sell-off in front of the Fed, they get that initial pullback at that first target, this downtrend line, and then rallied up here. So they bought it up. But the only thing different is, and I'll get to this in 1 minute, we now have on those remaining market leading big FANG stocks I covered the other day. Remember, we had divergence when I first covered them earlier in this week. I think Monday we were close on some like Apple and some others, but we needed to go up a little bit more. We got those divergences, and then those that didn't have it or weren't even that close at the time have it. So here's what I'm trying to say. Right now I have an even stronger case to be short than I did yesterday or earlier today even, based on this pop. I'll show you that in a second. So what I'm going to do, I'm going to run through the equity markets real quick. I mean, that's it. We still don't have, I believe it's imminent. That doesn't mean guaranteed. It's just my thought, is a break of this trend line. We started to ever so slightly, and I may have jumped the gun on firing that post off. I just wanted it to be timely. The QQQ post, 60-minute chart, have not modified this trend line. That's where we were just barely dipping below it, but we hadn't crossed below it on the NQ yet. And then sure enough, it was what we call a stick save, or just a whipsaw. The 60-minute candle has to close below that to trigger a sell signal. So we never got it there. It was intra-period. I fired it out again because I thought we would at least come down. I thought we'd get that pre-Fed sell-off. But my guess is, as I'm doing this video, we'll break down or shortly after Powell's finished speaking, because this is, again, it's the best looking, beautiful, or most beautiful rising wedge I've seen now for a while there. We've had some trend line breaks in QQQ triggering sell signals. We've had some divergent highs, but this one's clean. It's got the clean divergence. And again, when I say clean, it's so many reactions on this trend line. And therefore, a break of that trend line should bring us down. Again, this is just a minimum near-term target right now. That's first support, or you can call it a first target if you want. 309.27, a little shallow especially for swing trader, day traders. That's fine. 306.44 or 302.27 or 303.27, and then if we start to get some downside momentum, then again, this is the biggest level out there right now. The Monday the 13th, so the low from Monday before last, that is, I continue to maintain that has to go on all the indexes to really open the door for a bigger sell-off. Until then, bulls remain in control, but let's see how we close the day. Oh, and so remember, phase one is just that initial pop and fade and the knee-jerk reactions from the announcement. Phase two is Powell's dog and pony show, get up in front of the media and say what he's going to say. And then, and so that's really phase two and through the rest of the day. And then phase three is how we follow through in the coming days. Of course, tomorrow will be a full trading session, Friday, and then into next week. So here we go. We'll probably, I guess Powell's starting to talk, and I'll just keep looping back to this as I'm going over updates on other trade ideas. We'll watch a 1 minute chart, and then you'll see once we break, we're right on there now, and this is how this stuff works. I'm going to go to a 1 minute and show you the tick. We'll go to look at tick by tick. Well, that's 1 minute. This is a tick chart. And so if we go much lower, you break that support, and that's where you'll start to see a pretty sharp down. So I'll revisit this in a minute here. Let me get to some other trade ideas, because this is important. This is very important. See some comments. In the one person disgruntled about the semiconductor trade, which is a whopping, as of when I looked earlier today, down a whopping 2% from where we first shorted it on February 8th, and every other I highlighted a few other short entries back to that level. I'll get to the semis in this. Let me make sure it's on my notepad. Yeah, it is. Okay, so this is going to make your head spin. We'll revisit this, but there it is. Now we're starting to crack, and then and Q, very close but not there yet. And so by the end of the video I'll update this, and I bet you there's a good chance we're going to be all the way down, and that's how this works. We won't just limp on down through there. We'll probably come down pretty hard, and then yeah, and everyone will blame it on what Powell says, but to me it's priced into the charts. All right, let's get on to trade ideas, trade updates. So what I was saying a minute ago, diversify, diversify, diversify. It is as important every bit in active trading, swing trading, trend trading, as it is in investing. So I'm just going to rifle through a handful of other trade ideas, because the markets are not everything. They're certainly not everything that I hold. Yeah, obviously I've been pretty strong on my convictions where the market's going, despite the resiliency of the trend lately. But I've also mentioned taking other positions, both long and short, individual stocks and various asset classes, because part of diversification to me is not just diversifying among 10 or even 20 different stocks, because you're still in the stock market. Those are equities and they tend to move together. Of course, it can be in different sectors. That helps as well. Diversification among different sectors in the market, but then most importantly, diversification among different asset classes, which we call asset allocation, commodities being one. And then there are different types of commodities. Crude oil has nothing to do with corn or soybeans, or pick any other commodity you want, lumber. And this is crude, so I mentioned this one, taking this as a hedge the other day. Now I want to mention time to take profits. If you didn't, there was a profit taken up, that first target right there, 69.83. And I told you the other day this was only a potential downtrend line if we get a reaction there. So maybe at least raise stops if you took it in here. If we can punch on through there, that is the next potential resistance slash target, 72.59. But I just wanted to point out that we have are at that trend line now, and there is some small divergence here forming on the 60-minute chart. So one option too is to tighten stops a little more aggressively. I mean, there's support if it gets a reaction off there, which is probably what we'll get, at least a little bounce, even if we're going through the trend line. Oh, and you can also draw a different uptrend line right there. So there's a confluence of support. I think a stop just underneath there is reasonable if you're holding out for more. But again, it's, look for these divergent lows. This is simple stuff. Divergent low and a security nobody wanted to buy a few days ago because crude's been in a relentless downtrend. So that's crude oil. Just wanted to give you an update there. The VIX, well, like I said, to be long and bullish the VIX is to be short and bearish the equity market. They're either going to both play out or not, because the VIX goes up when stocks go down. And here we are. We've had two opportunities today to buy at that trend line. The first one gave us, it was a tradable bounce. If you want to just do a pre-Fed trade, it was good for about 3.5%. But we're there again, and that's simple. That was pointed out there. And so as long as this holds, if it coincides, if we get a breakdown in the NASDAQ 100 and the other indexes soon, then this is still a potential target. Somebody made a comment when I draw these arrows. Yeah, that would entail more than just a minor pullback here. It would entail to really take out these highs recently. Most likely it means we're going to take out Monday's low, Monday before last, or Monday before this Monday, last Monday. We're going to take that low out if the VIX is going to do this. But it was simple. I gave you that. There's S1, S2, two different support levels that are just a hair below. Anything much below that, then that's where you want to start looking to stop out. Where your stop is depends on where you think the VIX might go. If you think the VIX is going to potentially do that, then you can give it a wider stop. If you only want to game a little reflexive bounce, then you keep a much tighter stop. Alrighty, next up will be, let's look at a few individual stocks, and I'll try to get to some other things, gold and all that stuff. Individual stocks, that's where at least for me, most of my returns have been lately because the market's been grinding around, going pretty much nowhere. MBII, this one's worked out really nice. Short of that on the break, you had a break of the trend line there, hit the first target, overshot it with a little momentum overshoot, only to close right on it that day, right above that first target. So that was a very objective level to cover and or game a bounce, and then highlighted there right there yesterday on the back test of that downtrend line, and pretty much right before the uptrend line. And in just one day, that's another 8.5% on that trade. So this is wash, rinse, repeat kind of stuff. You make 9, 10, whatever it was percent on the downside, you recycle in, game the bounce for 8, 9%, and then turn around. Now you could have made easily 20, 25% on this trade just in the last few days, bouncing it between support and resistance. And once the T1 level goes, at this point you have a reaction low a little bit below that. So I'm going to put a line there, and I'm also going to set an alert, and this tells me to add to it. I did short it yesterday there, but I'll add to it on a break below the recent low, which also comes in with that gap right there. So trying to get that nice and tight. Set alert, close enough. That gives me a heads up in case I want to add to that. And why would I add, or why wouldn't I? Well, if I'm wrong on the stock market, MBII is probably going to hold up. This is sort of a play on, like I said, the ripple effects in the financial sector. One of the largest bond insurers right there. So, all right, not much more to say on it, other than that it's playing out right, and this is a world of a swing trader, and this is how, even in a sideways market grinding around, you can usually outperform the market by trading individual stocks and actively trading those. Next up, on a related note to that one, was AMBC, Ambac Financial. Came very close to the first target. Down today. Also notice this, that both AMBC down 2% and MBI, closely related companies, are MBI down 4.2, 4.25 right now. They're down in a green tape, in a solid green tape, and with the Fed coming in and cowing down as expected, away from their 50 basis point expected cut, which they only, 3 weeks ago? Powell was telling us to expect 0.5%, and now as expected, he's cowing down, and yet these stocks are going down, so there's something wrong. Why aren't these rallying with the market? So anyway, I like them, and hey, they either pay out or they don't. If you shorted there yesterday, you can have a stop just above those levels. This stock has no reason now going above the trend line. So don't let it winner turn into a big loser. There's no reason. Caterpillar was another one. This one worked out great. Covered there, bounce, mentioned that there was very good chance of a bounce. That was a big support level, big old gap there, major support, and very oversold when we got there, at least near term. First oversold reading on the RSI since right there, and you can see what happened there. So that's a target that you game a bounce on, and boom, and game it right back into and we're right there. I highlighted yesterday. We're still at 226.30. So if you believe this one has more downside like I do, then that's where you reshort, or if you missed it the first time and didn't get any of that or that, then that's an objective short level right there, T4 and T5. T5 is that's only going to be hit if I'm right and there's another leg down to come in the bear market and we have not seen the lows, meaning the October 22 lows were not the lows, just an intermediate low for a bear market rally. Otherwise, maybe even then, maybe we'll only get to T4 if that happens as well. So like everything else, there's no guarantees, but spread it around, and these are what's working, these trade ideas, and that's why I wanted to just kind of reiterate that that whole diversification thing. Tzu, still waiting on a buy signal. Like I was very clear that would be the next break above. I have resistance 568, but I said the next break above 570 because we popped it on an intra day, a very fast momentum fueled overshoot. We also got capped at the 200-day moving average, which has been capping all the advances in the bear market. So we need to power up through there, and if we do, then that's going to break out both above the 200, and the fact that we're already pierced it once, it's pretty darn good resistance. So that one remains a trade setup, not an actionable trade. Possibly on a pullback to test the trend line, or maybe even a gap backfill, but I wouldn't like a gap backfill because a gap backfill would mean that the trend line breakout failed. So let's just keep that as the sole criteria on there now. And again, a trade setup, not an actionable trade. There's a big difference. Trade setup is a potential trade pending a certain buy criteria for a long or a certain sell signal for a short. TPIT was one. I'm just going through every trade idea I remember giving you in the last couple of weeks here. TPIT, still working on it. Still in no man's land, halfway to T1, T2. Not much to update. Negative divergence. I still like it. Intel, that one's over with twice. It was a long here, hit T1, hit T2, which case I mentioned is an objective short to reverse, and told you I covered that the other day, and still think it's the meat has been milked off that bone, excuse me. In other words, the long 20, what was it, close to 20%, then the short pullback trade, what was that close to, depending on when you took it, 6-8%, maybe more. And now it's kind of in no man's land. So what I'll do is I'll watch Intel. I just have no desire to re-engage at this point. You have support down below here, and you have resistance. This is a basing pattern. If we're in a bull market and the market's going to new highs and the semis are going to break out, then Intel is going to come up here, and this would be my target. Next target. Well, any of these lines, I should say. See all my potential targets are marked. Their resistance levels. And that's going to entail the market rallying from here, and the semis rallying and everything else. And then this will be one of my favorites at that point in time, because that's a strong, nice basing pattern, positive divergence, everything I like to see on a stock. And then you also have the 200-day moving averages. See how these beauties have capped all the advances since this bear market, and then since it peaked back here. And there had some cracks showing in the stock back here. Intel's had some problems where you were below, got rejected, the 200 rejected. We took it out, successfully backtested, backtest, but then we failed it again. That put this one back into a sell signal for a trend trade. Okay, so that's it. Bottom line is, if I don't have it already, set an alert above 31.12. That's going to be bullish. But then you'll want to watch, make sure it clears the 200s maybe before going to a full position, and also, of course, see what the semis are doing at the time, see what the market's doing at the time. What else have I given you lately? Gave you those treasury bond trades, but I suggested that get out before the Fed today. There was no reason. They hit our bounce targets. There was a ZN. I might have given that to you. Did I give that to you on? Might have been on this time frame. Yeah, set cover there. That was a short from the other day. Play the bounce off that level, and then ZB as well. So I just wanted to say I have no position or no idea where they go from now. All I can tell you is this was pretty significant resistance here, and you had a nice bearish rising wedge, pretty much textbook with the divergent high, and that appears to be just the initial leg down. Now you can also use this if you want as a hedge, whether you're long or short the indexes, the stock market, because this is most likely going to trade inversely. If the stock market rallies, it is the market telling us and market participants that they think the worst is over, that the Fed has backstopped the financial system, that the economy is not going into a recession despite the very overwhelmingly strong evidence against including but not limited to the yield curve inversions. And so either way is this is a way to have an indirect hedge, and that doesn't always work. Indirect hedge, a direct hedge, if you're long the S&P 500, is you can buy puts on the S&P 500. That's the direct hedge. But you're going to have expenses and wash out. I prefer the indirect hedges typically, and that's just one. So I don't want to spend much more time on them because I don't have a very strong, I don't have strong convictions on the near term. So I'm standing aside. I'm just trying to again follow up on all the recently highlighted trade ideas. Gold and silver. Let's talk those guys. Okay, told you yesterday. Cover there. We had a little divergent high. That was a good level to cover. Same thing. I do not have positions right now. I'm waiting for the next objective entry. I'm waiting to see which way this market breaks. But just like treasuries, we're just recently coming off that divergent high. Hit the first target and bounce as expected. That's typical on the first. But there could be easily another leg down. I'm just not sure. I'm going to get to the US dollar and the euro in 1 second. But either way, kind of standing aside, watching those. I just don't think the risk reward is very attractive on either long or short right now. Let me try to grab you silver. That is SI right here. Okay, here's one. Big resistance right up here. It almost got there, and it's very close now, 23.43. So if I were long silver right now, I'd be selling either right now in this back test, or I would, or very least moving stops up and getting ready to reverse it there at 23.43. So again, just to kind of reiterate here or recap this, divergence has only gotten larger since this divergent high right here where we had the breakdown. So this is a breakdown of the wedge and a back test. So all I'm doing is extending my divergence line and telling you that it looks like silver, the upside is limited before the next leg down. Now, this is where I wanted to get to on the gold silver trade and the stock market. If you recall, was it just about a week or so ago, and I was kind of struggling with the words. I was calling it maybe a soft pivot on gold in the stock market, or gold in general, because the outlook for the euro and the US dollar, I couldn't have it both ways. And I showed you, and it would take too long in this video, I went through there and showed you a very, very strong and unmistakable correlation between the euro, which moves inversely to the dollar, or the euro US dollar pair we're looking at here, and gold and silver. So when this goes up, gold and silver go up, they rally. Okay, and there's the rally recently. This was gold and silver were going down here, and they were going up here. Back here, after being long and closing out those longs, we shorted gold and silver, and I was bearish, calling for a pullback to this level with a resumption of the bull market. So far, that has been the case. You can see us coming off that trend line sharply. However, as I said before, the problem with the whole bear market thing and another leg down is unless these relationships completely disconnect on one or the other, you can't have it all. You can't have the euro, gold, and silver going up and the stock market falling, because the stock market, as I told you before and I overlaid it, has been positively correlated. So let me do the comparison there's a stock market. So what is, you can see one goes up, I put it in purple, it's the S&P 500. So if the euro continues to rally and this continues to play out, then that's going to be bullish for the stock market, unless there's a complete decoupling or an inversion of this very obvious and tight positive correlation here. And so therefore, again, that's why I kind of struggled with how to define it. It was just that, hey, guess what, guys? I'm either going to be wrong on one or the other. And so I stuck with, and I am sticking with for now, my longer term bearish outlook on the equity markets. It's just softened up my long term bullish outlook for gold and silver. That's all. And that was what I was saying then, I'm trying to say now. And from when we look at the daily chart, I just showed you the 60-minute chart. Here's something else that says that the recent rally in the euro and the drop in the dollar, which is given this rally in gold, may come to an end. This is the first divergent high on GLD. It's not confirmed yet. We need to have the PPO crossover, but we clearly have negative divergences, right, on gold right now. This was positive divergences right here, bullish, divergent low. That was a big level here when we regained 150. It was that bear trap scenario I laid out before in gold. When we broke down, if we recovered, and we did, and it was powerful. However, how much of it's run its course? All I can tell you is we have negative divergence. Gold's at resistance. Next big resistance is there, but if it gets up there to challenge those two previous highs, you're going to have taken out the divergence. So as of now, I will say I'm leaning towards this, okay, or at least the downside scenario, and I am still leaning towards, without wavering, and we still haven't broken down yet on QQQ. Here we are, we're still above that trend line. I'm still leaning towards this. So I'm not even watching the press conference right now. Powell's telling the market what they want to hear so far. But I'm pressing my shorts. That's just me, because this looks like an imminent breakdown to me. And then I think once it does happen, I think you have a lot of non-believers. I think it's going to be a pretty powerful thing. And anyway, I told you, if and when I change my outlook, and I'll let you know, but don't follow me. Do your own thing. SOXX semis. This is what I was talking about the other day. So being long Intel, and I also mentioned that when I went long a couple weeks ago, Intel, that it was a hedge to the semi short. So I first put the semis on a short here, right here on February 8th. That candle right here. In a video, Semiconductor Trade Ideas, along with PSP, the private equity, and then I've highlighted each and every rally back to here. So we're really right about where we were, as I said, within 2% of where we were on that initial short entry and all the other objective short entries here on the bounce back to that 424, 425-ish level. And we're also right at that previous reaction high, just like the NASDAQ 100. And the only thing that has changed since this initial short entry or the other ones here, the only thing, just like when I'm about to wrap the video up with the things, is that now, back then, the divergence was right here. Now we have a steepening of the divergence, meaning there's even more pronounced negative divergence. See these indicators? I just drew the lines. We have now a higher high, a marginal new high, and meaning a slightly higher high, and it's still a divergent high, and therefore I maintain these targets. I know it's probably one of the very few out there bearish and short the semis right now, but I'm still maintaining these targets. T2 was, what was that, asterisk, the trend line, or did I add that level on? What did I put? Yeah, I said first of the trend line, so there's still, I said, or 391 support. I just threw a new line in there at 397.33. It defines these lows, but that's still the next target. And the thing about this, guys, if I'm right, it needs to happen soon to keep these, ideally, to keep the divergences intact. And if it starts to happen, well, if this happens in the semis, it's going to take QQQ down and trigger that sell signal on that below that trend line. And then if you take out this trend line, well, it'll open the door to a much bigger sell-off. So again, because there was a comment made about it being horrible. If you can't tolerate a 2% stop loss, you're in the wrong game, the wrong business, or a 2% drawdown, on a trade. Gosh, I trade the semis. Sometimes I'll give them 10%. It depends on my target. It depends on your target too. I mean, if you're looking long term, I have long term targets that are down here. These are my bear market targets. Or next one, T2, is all the way down here. I have price support 271 and the trend line, and you're talking another 37%. Even to hit my T6 right here in the daily, you're talking 22%. So you can give yourself, if you use a 2-to-1 risk reward ratio, or RR, you can give yourself a 10% stop loss and you're still well within that. But hey, that's not for you. It's not for everybody. I mean, some people like to keep stops tight, and all I can say, if you 2% drawdown on a trade from entry exceeds your comfort level, you're trading the wrong securities. You should not trade semiconductors, natural gas. You probably shouldn't even trade the NASDAQ 100. You should be with treasury bonds, or really kind of into CDs and bank stuff. That's a relatively small drawdown in my opinion, especially when you look at the profit potential if it does pan out. All right, so last thing is the FANGs. I told you, just going to go to the 60-minute chart, because the other day told you we had divergence on QQQ, but we needed to see it, or I didn't say we needed to, but we were very close. And so since then, we were right here, I think at the time on Apple, a little before that. And so now you can see we have clear negative divergence. I'm just going to draw it out. And all I'm doing right now is going through the top components of the NASDAQ 100 and S&P 500. So this right here, this is your divergence that we didn't have the other day. Here's our marginal new high that gave us divergence now on both indicators, including the RSI. So Apple, 60-minute divergence. Microsoft, 60-minute divergence. Alphabet, Class A, now, which we didn't have the other day, and I didn't think we were going to get, but we do have it. Nice steep bearish rising wedge with a divergent high, positive or negative divergence. Amazon, didn't have it the other day, have it now. There's your negative divergence right there. Gives us a nice clean bearish rising wedge. And I would rather be wrong than to pass on the setups that are my type of setups, and these are my kind of patterns. Swing trade these 60-minute divergent highs and divergent lows, and once we break these, that's on all these collectively, if and as each one breaks down, meaning Apple, Microsoft, Alphabet, Amazon, those are additional check marks or reasons to be short or add to any short positions, in my opinion. First and foremost, we need to see that 60-minute trend line on QQQ give way, which I'm about to wrap up here, and I think we're going to have it just as I wrap the video up. Again, that's why I tried to time it to show you that breakdown. That's Tesla, remember. Shorted Tesla here. I mentioned covering it there, game in the bounce, but this is a beautiful re-entry if you want to short it. Downtrend line, resistance at 200, and it's about the only one that I don't see divergence on the 60-minute chart. And to bring this video home, 60-minute intra-period candle. It hasn't yet finalized. See how it's moving. That's going to finalize. We're just started. It's 3 o'clock, so this is the last candle of the day. I'm guessing we're going to close it all the way down here. It's going to be one big powerful red candle, would be my guess. Let's see if we cracked yet on NQ. Not yet. Very close. I was really hoping to see the full breakdown and just show you how it starts to build steam when you go down here. Like I said, Qs are cracking, but you do need to see the NASDAQ 100. So this is just the tick, showing tick by tick here. And it's holding, it's bouncing, it's trying to hold on that trend line. This NQ buyers are stepping in and buying yet another pullback to the trend line. But so either way, I'll do an update at the end of the day. We'll see if we get that. And that's what you want to look for to decide whether you want to go home long or short. You get breakdowns. And as I like to say, the redder the better. We'll get this final 60-minute candle. Are we going to take out or park on or above 309.27? If our, first off, are we going to close below the trend line? That's first and foremost. To get a solid or confirming sell signal, you need a candlestick close. In this case, a 60-minute candle and a daily. That's the same thing because we're on the last candle of the day. So if you just roll out to the daily time frame, you can draw the same trend line there. And you shouldn't have to squint and see, okay, is it red or not. You want to see something like this, and maybe it doesn't come today. But if it does, as I say, the redder the better. I know I'm using a blue tool. Actually, this is today's candle right here. So are we going to close below it? And, I'd have to tighten it up like that. That's how it would look. All right, I'm going to wrap it up here, get the video out to you, and you know what to look for. So unless anything really big happens by the close, the status quo right now is we're still above trend. We're above it on NQ, just starting to crack on the 60 on QQQ, but not far enough. And again, you can't see, we're not below it on the daily. So as of now, that sell signal is still pending, but in my opinion, very high likelihood. And even if it's against, well, it's against everyone else's odds, it's against the odds of what the current trend are, not my odds. My odds are what I think is going to happen despite the resiliency of the current trend, the bullishness of the masses. I put it good enough odds that no matter what they do today, I'm going home short the indexes. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.